If you don't understand index funds, you don't understand investing. I know how that sounds. It sounds arrogant, like one of those lines designed to make you feel small so you'll keep watching. Let me earn it. Because here's the thing. Nobody says out loud. An index fund is not a product. It's not a stock. It's not even really an investment in the way most people use that word. It's a mirror. It quietly reflects the entire machine of capitalism back at you. And once you actually understand what's happening inside it, you can't unsee it. You stop chasing the next hot ticker. You stop feeling broke for not picking the right stock. And you start to see the one boring force that builds almost every fortune that lasts. So in the next 20 minutes, I'm going to take this thing apart, screw by screw, until it makes complete sense. My name is John, and I spend a genuinely unreasonable amount of time thinking about why most people who try to invest end up worse off than people who do almost nothing. If you're someone who feels like investing is a casino you keep losing at, make sure to hit that subscribe button and give this video a thumbs up if it helps you out. Quick disclaimer before we go anywhere. I'm not a financial advisor. This isn't financial advice. This is for educational purposes only, and your decisions are your own. Good. Now let me show you what an index fund actually is, because almost everything you've been told about it is either incomplete or flat out wrong. Let's start with the bare bones definition, the one that fits on an index card. An index fund is a basket. That's it. Instead of buying one company's stock, you buy a single fund, and that fund owns tiny slices of hundreds or thousands of companies all at once. The most famous version tracks the S&P 500, which is just a list of roughly 500 of the largest companies in the United States. When you buy an S&P 500 index fund, you are, in one click, becoming a part owner of Apple, Microsoft, Amazon, Coca-Cola, your bank, the company that makes your toothpaste, and around 495 others. You don't pick them. You don't research them. A set of rules picks them for you, and the fund just owns the whole list. That's the whole thing. And I know what some of you are thinking right now. John, that sounds lazy. That sounds like giving up. If I'm not picking winners, am I even really investing? Hold that question in your head, because by the end of this video, I'm going to show you that picking winners is the lazy story we tell ourselves, and owning everything is the disciplined one. But first, you need to see the scale of what you're actually plugging into. Here's a number that might reset your brain a little. The total value of the US stock market is somewhere north of $50 trillion. That's not a typo, and it's not a metaphor. 50 trillion. When you buy a total market index fund, you're buying a proportional sliver of that entire ocean. And here's what that means in human terms. Every morning, millions of people around the world wake up and go to work inside the companies you own. Engineers ship code, factories run, trucks deliver, ads sell. And at the end of every quarter, the profit from all of that effort flows, in a microscopic but real way, back toward you. You become, functionally, a silent partner in the broad economy itself. That's the part most people never internalize. They think they're buying a number on a screen that goes up and down. They're not. They're buying a claim on human productivity, and human productivity, over long enough stretches, has only ever gone one direction. Up and to the right, with terrifying dips along the way. Stay with me, because that phrase, terrifying dips along the way, is where this entire video earns its title. Now let me introduce you to two people, because abstract numbers don't change behavior, but watching someone else win or lose does. Meet Jake and Marcus, same age, both 30, both making 70 grand a year, both deciding on the exact same Monday that they're finally going to take investing seriously. Jake is the one you'd probably root for at a party. Jake reads the news. Jake follows 3 finance accounts, listens to a couple of podcasts, and has a watch list. Jake is going to build a portfolio of individual stocks, the companies he believes in, the ones with the real story. Marcus, honestly, is a little boring. Marcus reads the same news and shrugs. Marcus buys a single S&P 500 index fund, sets up an automatic transfer of $500 a month, and then, and this is the important part, Marcus essentially stops paying attention. He doesn't check it daily, he doesn't tinker, he just keeps the pipe flowing. Now quick gut check before we keep going. Be honest with yourself. Which one are you? Which one do you want to be? Because almost everyone watching this instinctively wants to be Jake, and that instinct is exactly the thing that costs people the most money in the world. Let me earn that claim too. Here's where it gets really interesting, and where the first uncomfortable truth lives. There is a study that finance nerds cite constantly by a researcher named Hendrik Bessembinder, and it looked at decades of stock market history to answer one simple question. Where do all the gains actually come from? You'd assume the answer is, broadly spread out. Lots of companies doing okay, a few doing great. The answer is far stranger than that. Bessembinder found that the majority of the entire stock market's wealth creation over the long run came from a tiny fraction of companies. We're talking a small single-digit percentage of stocks, generating essentially all of the net gains, while while the majority of individual stocks actually underperformed safe, boring treasury bills or even lost money outright over their lifetimes. Let that land for a second. Most individual stocks are, statistically, losers or laggards. The market only goes up because a handful of monster winners drag the entire average upward. So now think about what Jake is really doing. Jake isn't just picking stocks. Jake is trying, with his hobbyist research and his watch list, to reach into a haystack where most of the straws are duds and pluck out the few golden needles before anyone else does, repeatedly for 30 years. And here's the part that should make the hair on your neck stand up. Even the professionals, the people who do this full-time with teams and supercomputers, mostly fail at it. I want to be fair here, because if I only showed you the case against picking stocks, I'd be doing exactly what the hype influencers do in reverse. So let me give Jake his strongest argument. Yes, some people genuinely beat the market. They exist. Picking the right single company early can absolutely make you richer, faster, than any index fund ever will. If you'd put your money into the right name 15 years ago, you'd be sitting on a fortune that makes Marcus look like he's standing still. That's all true, and I'm not going to pretend it isn't. But here's the question that flips the whole thing. What would have to be true for that to be a reliable plan and not just a lottery ticket that happened to hit? You'd have to be able to identify those rare winners in advance, consistently, not once, and you'd have to hold them through gut-wrenching drops without selling, and you'd have to not get faked out by the dozens of exciting stories that turn out to be duds. And this is where the data gets brutal for the professionals. There's a scorecard called SPIVA that tracks how actively managed funds, run by experts, perform against simple index funds. And year after year, over long periods like 15 and 20 years, the vast majority of those professional stock pickers fail to beat the boring index. We're talking 90% of them underperforming the thing Marcus bought and forgot. So if the pros with every possible advantage can't reliably win this game, the honest question becomes, what exactly makes us think we can do it on a lunch break? Now, I know what some of you are saying, but John, the index fund is just average by definition. I don't want to be average. I want to win. And this is the single most important reframe in the entire video, so I need you to really hear me. The index is not average. The index is the score that the average player is trying and failing to beat. Owning the index means you automatically own every one of those rare monster winners, the golden needles, because they're in the basket too. You never have to find them. You never have to time them. You just have to own everything and let the winners do their job. When you buy the index, the small percentage of stocks that create all the wealth are already inside your fund, growing, dragging your whole basket up with them. You are mathematically guaranteed to capture the winners because you refuse to gamble on guessing which ones they'd be. That's the magic trick nobody points at. The lazy-sounding strategy is actually the only one that guarantees you can't miss the companies that matter. Onward, because now we have to talk about the second silent killer, the one that has nothing to do with picking stocks at all. Let's talk about fees, because this is where regular people get quietly robbed in slow motion. Every fund charges something called an expense ratio. It's the annual cut the fund company takes for running the thing, expressed as a percentage of your money. A typical actively managed fund, the kind with a clever manager promising to beat the market, might charge somewhere around 1% a year, sometimes more. A broad index fund, you can find them charging around 0.03%. Now 1% versus 0.03% sounds like nothing. It sounds like rounding error stuff. Here's the data sandwich though. Watch what that tiny gap does over a lifetime. Imagine two investors, both put in $500 a month for 40 years, both earn the same underlying market return of, let's say, around 7% after inflation. The only difference is one pays 1% in fees and the other pays basically nothing. Over those 4 decades, the low-fee investor can end up with hundreds of thousands of dollars more. In a lot of realistic scenarios, the high-fee investor hands over a quarter, even a third, of their final nest egg to fees they barely noticed. Same contributions, same market. One simple difference. And here's the part that really gets me. The high fee fund usually performs worse before fees too, because remember Spiva, most of them don't beat the index. So you're often paying a premium price for a worse result. You're paying more to lose. The index fund wins twice. It captures all the winners and it almost never bleeds you on fees. This is why understanding index funds is understanding investing. Once you see this, you can't unsee it. But I told you there'd be a terrifying part and I'm not going to skip it. Because the people who only show you the smooth upward chart are setting you up to fail. The index does not go up in a straight line. It goes up in a jagged, violent heart attack of a line. Let me give you the real history. In 2008, the S&P 500 lost roughly half its value. Half. Marcus, if he existed back then, would have watched his account get cut in two while the news screamed that capitalism itself was ending. In early 2020, the market fell more than 30% in about a month. A month. People who'd been calm for years suddenly felt their stomach drop and started selling at the exact worst moment. And this is the real test of whether you understand index funds, because the math only works for people who survive these moments without flinching. Here's the brutal thing about a crash. The drop isn't the danger. The drop is temporary. The danger is you. The danger is that you panic, sell at the bottom, lock in the loss, and turn a paper dip into a permanent wound. Every single one of those historical crashes, everyone, eventually recovered and went on to new highs. The market has never failed to recover, given enough time. But your nerves can fail. Your discipline can fail. And that's why most people, even people who own index funds, still lose. They own the right thing, and then they behave like Jake at the worst possible moment. Let me make that concrete, because there's a statistic that haunts me. There's a research firm called Dalbar that studies how actual investors perform versus the funds they own. And here's the gut punch. For decades, the average investor earned dramatically less than the very funds sitting in their account. How is that even possible? It's possible because they bought high when they were excited, sold low when they were scared, jumped in and out, chased whatever was hot, and abandoned ship every time the water got rough. The fund itself did fine. The human holding it did not. So understand what this means. The hardest part of index investing has nothing to do with intelligence or research or picking the right fund. The hardest part is sitting completely still while every instinct in your body screams at you to do something. Marcus's real edge over Jake was never that he was smarter. It's that he was boring. He automated his contributions so the decision was already made, and then he refused to touch it when the headlines got loud. That's the whole game. The discipline is the strategy. Now let me address the objection forming in the back of some of your minds. Okay, John, fine, but isn't America just one country? What if the US is the next Japan? What if these companies stagnate for 30 years? Am I putting all my eggs in one basket? It's a genuinely fair concern, and I want to be honest about it rather than hand wave it away. The answer is that the index fund concept doesn't stop at the US border. You can buy a total world index fund that owns companies across the entire planet, developed and emerging markets together, thousands and thousands of companies across dozens of countries. The exact same logic scales up. Instead of betting on one company or one sector or even one country, you own a slice of global human productivity itself. Now you're not asking, will Apple win or will the US win? You're asking the only question that's ever had a confident answer over the long arc of history. Will humans, collectively, all over the world, keep getting more productive, building more, inventing more? And every century of data we have says yes, in fits and starts, with wars and crashes and disasters in between. But yes, that's the bet an index fund really is. It's the most diversified bet on human progress that an ordinary person has ever been able to make with a single click. There has never been a tool like this in human history available to a regular worker. Kings couldn't do this. Your grandparents mostly couldn't do this. You can do it from your phone in about 4 minutes. So let me pull the pieces together, because I want you to walk away with this fully assembled, not just impressed. Why does understanding index funds mean you understand investing? Because every real lesson of investing lives inside this one instrument. Lesson 1, you cannot reliably pick the winners, so own them all. Lesson 2, fees are a silent tax that compounds against you, so keep them brutally low. Lesson 3, returns come from staying invested through the chaos, not from being clever, so automate and don't flinch. Lesson 4, diversification isn't a consolation prize for people who aren't smart enough to concentrate. It's the mathematically dominant strategy that the smartest people in the world quietly use with their own money. Warren Buffett, arguably the greatest stock picker who ever lived, has instructed that after he's gone, the bulk of the money left for his family should go into a low-cost S&P 500 index fund. Read that again. The single greatest stock picker in history wants his own family in the boring index. That should tell you everything. The man who beat the game his whole life knows that almost no one else will, and he's not willing to bet his family's future on them trying. Let me give you the honest countercurrent too, because I promised fairness and I meant it. An index fund will never make you rich overnight. It is genuinely slow. For the first few years, it can feel like watching paint dry, like nothing is happening, like you're being financially responsible into a void. And in a single bad year, it will absolutely show you a loss that makes you question everything I've just said. I'm not going to pretend that's fun. There will be stretches where Jake's hot stock is up 100% and your boring index is flat and you'll feel like the idiot in the room. That's real. I want to be careful not to oversell this. But here's the thing about the slow years. The math was never broken during those quiet stretches. It was loading. Compounding does almost nothing visible at the start and then becomes absurd at the end. And the price of admission to that absurd back half is being boring enough to still be standing there when it finally arrives. So where does that leave you practically? There are really three paths in front of you here. The first path is the hype path. It's the one where you chase the next big thing, the stock everyone's screaming about, the strategy that promises to 10x your money this year. That path is exciting, and it's a slot machine, and the house, over time, takes nearly everyone. Dismiss it. The second path is the cynic's path. It's the one that says the whole thing is rigged, the market's a scam for rich people, so why bother at all? Just keep your cash. And I get the anger behind it, but that path guarantees inflation quietly eats your money for the rest of your life while you do nothing. Dismiss that one too. And then there's the third path, the quiet one. You pick a low-cost broad index fund, you automate a contribution you can actually sustain, even if it's small, even if it's embarrassingly small to start, and then you do the single hardest thing in all of finance. You leave it alone. You let the winners hide in the basket. You let the fees stay near zero. You let the crashes come and go without touching a thing. You let time do the one job it has never failed to do. That's not the sexy path. It's just the one that actually works. But honestly, take the habit with you. The habit is the whole thing. Here's my question for you, and I genuinely want to read your answer in the comments. Be honest. Which one have you been so far, Jake or Marcus, and which one are you going to be starting now? Drop it below. And quick reminder one more time, I'm not a financial advisor. This was for educational purposes only. Your money is your responsibility. Thanks for watching, and I'll see you in the next one.